Can we just start with China for a second and what you made overnight of the NPC, conflict with Hong Kong, conflict with the U.S.? How are you, the EM investor, digesting all of that?
Well, there's no question that the tensions are rising. And of course, these tensions have been going on for quite some time, in the beginning with this trade war and a number of other factors, so that we can't expect to be seeing any let up in this kind of tension. Nevertheless, there are lots of stocks in China that can be purchased that are very profitable and are growing despite all the problems we're seeing. So I think we have to take it stock by stock rather than making a general picture of the Chinese market.
Well, help me understand then how you screen stock by stock and sort of how then that plays into what the government is going to do in terms of stimulus.
Well, number one, we're looking at stocks that are not going to be impacted by a trade war. That's number one. Number two, we're looking at stocks that have a global footprint. So you have many of these Chinese stocks. Well, Alibaba is the obvious one that they have a global footprint in addition to having this incredible market share in China. And then number three, we want stocks that have very, very strong balance sheets. At this stage, we have to have companies that are able to acquire other companies and gain the market by doing so. So those, I would say, would be the characteristics we're looking for in the Chinese stocks.
Can you give me some names? Because all you wind up hearing about with Chinese companies is how much debt they wind up having and how much help they're going to need from the government. So what are these names?
Well, I mean, if, for the normal investor, these big names like I mentioned, Alibaba would be the obvious one. But there are a number of others similar to that would fall into that category. I can't give you the names because we may be buying, so I don't want to be in that position. But generally speaking, any of these names, like Alibaba, like Tencent, these are companies that should be looked at.
Okay, fair enough. If, though, some of those companies, and we can stick with the big ones, like an Alibaba, get delisted from the Nasdaq, for example, because of these trade tensions, does that affect how you think about them at all?
Not really. I mean, I know that Congress is now going to pass a bill about accounting practices. The companies listed in New York have to follow U.S. accounting. That's not going to be any problem for these companies because they already are doing international accounting, and it'd be very easy for them to come up with the right accounting practices. So I don't see that as a big problem. So I think what you've got to see is any problems in the face of sanctions as regards to technology. Now that's an area where you have to be very cautious. But even there, if you look at a company like TSMC, they'll be able to survive any problems with the market in China, simply because they're a global company and supplying people globally, including many of the US manufacturers.
Are you worried that we're going to see any sort of supply chain shifts that we were already talking about accelerate because of the virus? Or does it not matter as much if you're looking for the right kind of companies that would be more immune to something like that?
Well, this is already taking place. I mean, you must remember, it's not only the American companies that have a supply chain problem, but it's the Chinese companies as well. They have to now look afield out of their own area to find out where they can get their supplies that are not going to be sanctioned by the U.S. in one direction or the other. The interesting thing that's happening is that many Chinese manufacturers are moving outside of China to manufacture in other countries so they can get under the U.S. trade barrier. So that's another thing you have to look for. And we're looking at such companies that are strong in China, but are moving globally and are becoming more of a global supply chain company.
Where else do you like in emerging markets? We have seen rate cuts like India, surprise rate cut overnight of 40 basis points. We've seen stimulus, some coordinated debt monetization. I mean, we're doing everything in emerging markets. Where's the best opportunity?
Well, India, obviously, after China, you have to look at India because it's so huge and so many things are going. The market has not done very well recently, but I believe that they're going to pull out of this and really move from strength to strength. And by the way, this is a good example of supply chain where you're going to see a lot of the manufacturing that's now in China moving over to India. It's not going to happen overnight, but this is a trend that we're seeing. You must remember, India has been very, very successful in exporting software outsourcing has been an incredible business for the Indians. And I think they're going to be equally successful in outsourcing of manufacturing.
How do you, though, then think of the debt load that emerging markets and companies are going to be saddled with? I know you said you like to look at companies that don't have a lot of debt, but the countries overall are going to have a tremendous amount of debt, with debt forgiveness still a real contentious issue. How should an investor think about that?
Well, the good news is that debt markets have very short memories. If you look back in history, people were bombed out of Mexico for a long time. There were problems in Argentina. I don't know how many times you've had problems in Argentina, but they always come back for more punishment. Of course, some people make money on these very, very low markets where the rates go through the roof. But the good news is that with the Fed lowering rates, with the Europeans, of course, already in negative rates, where do the debt buyers go? They go to these high-risk countries. So I think there's going to be plenty of opportunity for Argentina and countries like that to restart their economies with more debt.
Wow. Okay. So just to be clear, even though Argentina is on the brink of default again for the 9th time, because the Fed is so invested in the market, you think that's going to have to push out investors looking to take on more risk for the yield to places like Argentina?
Absolutely. You're definitely going to see that going forward. I mean, not tomorrow, but I'm talking about the next month ahead and this year ahead. You're going to see more people gravitating to emerging markets debt, and particularly high risk debt, which pays high yields. So this is something that you have to look for.
Where is the best high risk debt, or where will it be when we get to that point?
Well, probably at this stage, probably Argentina. And I'm sure a lot of hedge funds are looking at some of this debt, picking up some of this at huge discounts. Argentina would be one. South Africa would be another. As you know, South Africa has been downgraded by Moody's, so they're now in junk territory. Maybe Turkey would be another one where they would be looking. So these are all areas where, there's lots of debt, but there's a history of eventually things being worked out. So at the end of the day, there's a price for everything, let's face it. And there's plenty of money sloshing around the world looking for a home.
There is a price for everything. That's true. Where would you not touch, though?
The obvious places like Venezuela, but even there you have to watch developments because things may change. I can't think of many places. Maybe Nigeria you'd have to be careful about because of the oil price decline. But at the end of the day, there are not many places where we would totally avoid. The only reason why we would avoid a place is because either there are strict foreign exchange controls, so we can't get money out, or there's certain restrictions on foreigners coming in. But other than that, there's always opportunities in individual names, individual debt names, and also, more importantly, individual equity names.
Really great perspective on that. How do you then, as Mark Mobius, who's looking to pick up some of these investments, look at the virus and the race for the vaccine, where it seems like one headline has the ability to turn the markets and sentiment around? How are you digesting that kind of news flow?
I think this vaccine thing is overdone. I really don't think it's that important, frankly, for a number of reasons. One, okay, let's say they find a vaccine, they talk about the end of the year. How long will it take for everybody to be vaccinated? I mean, this is just a no-goer. I think the only way out of this is to get people back to work, back on the streets, back shopping. We're seeing this here in Germany. People are shopping again. Okay, they're online, they're keeping their distance, they have their masks. But I think that's the only solution, particularly for emerging markets, where you have young populations who are resistant to these diseases. So I think let's not wait for the vaccine. I don't think that's the answer.